Okay, well, good afternoon, everybody. Thank you for joining today's webinar. My name's Lily Williams and I'm the Partnerships Manager at BGL. Today, we're joined by two of Option's property valuation expert, Anthony, Regional Director, and Ben, Director, Core Commercial. Option employs one of the largest professional teams of property valuation experts in Australia, with over 600 valuers and property advisors working across 98% of Australia's postcodes. This results in over 1,200 properties inspected every business day. So no matter where you are, you can trust Option for timely and cost-effective advice. Option's expertise ranges across an array of services and valuations for mortgage and non-mortgage purposes, not just property, SMSF, but also tax, specialist real estate, property development, quantity surveying, and much more. So before we get started, I will just cover some general housekeeping. Firstly, today's session will be recorded. So if you miss anything or you need to jump off early, you will receive a link to watch at a later date. And this recording is also posted on our YouTube channel. We will have the Q&A function available. So if you have any questions throughout the session, please pop them in there. And one of the Option team members will be able to answer your questions. So Anthony, I'll hand it over to you to kick things off.
Perfect. Thanks for the introduction. Yes, I'm Anthony Salsi, Regional Director for all things non-mortgage. As we mentioned earlier, when we saw the map of Australia, we cover all of Australia and there's 600 plus valuers. The beauty about that is when you're dealing with firms like yourselves is we are also one of the biggest mortgage providers in those regions. And that means that we've gone through most of the sales. Our information is very current. We've gone through all the properties. We know how big they are. We know the complexities in every apartment complex across multiple states. So being able to be really accurate, really fast is something that we take a lot of pride in. Now, if we just move on to the disclaimer before I start giving a bit of an education platform, I'll just read the first line and then I'll give a little bit of an overview while you all keep reading. So this presentation is provided for informational purposes only and does not constitute financial or investment advice. So as you keep reading, I've been a certified practicing valuer since 2005-6, around that time. I've also worked in credit for non-private ADI lenders. So I'm very equipped and very competent in complex trust structures and different special purpose vehicles that you may be required to undertake as part of your strategy. So again, I've been a certified practicing valuer. I'm also on the Australian Property Institute Review Board. I'm also a panel examiner for the API. So most valuers that are going through their certification will be involved with me on a training platform one way or another. If you move on to the next slide there, we've got a couple of poll questions that I wanted to ask before I went into a bit of the education platform. So has anyone here engaged a valuer to form part of your client's SMSF strategy? So I mean, actually not just requested a valuation, actually gone in and had a valuer form part of that strategy. And then the second question is, when recommending a valuation, is it basically the cheapest, or is there an alternative reason, or is it accuracy that is important to you also? So what's really interesting here is looking at those polls, a lot of you haven't engaged a valuer to be part of that strategy, which is really good, because that means that after this session, once I give you a little bit of education there, we can connect, we can collaborate, we can partner. And that's really exciting, because you can then value add to your clients in a way that you haven't done historically, which is really good. And then also, I noticed here there's quite a less amount in regards to cheapest, which is really positive, because you actually really do want someone that can give you the best advice at any given time. So that's really, really, really important. So moving on to the next slide, please. So SMS residential, so, and we can continue on to the next slide now. So looking at where I see most of our requests come through, most of it is annual audits, rental assessments, sharing property, transferring properties into related entities or different special purpose vehicles, or adverse possession claims is another common one. And we've also seen capital gains tax valuations, a lot more of that in recent times, especially after that big COVID boom we had recently. Stamp duty when transferring into an SMSF. And also we see a lot with developers applying for GST margin scheme, or what's not also noted there is sometimes public open space. They have to pay a fee when they've done their development, analysing that and helping them in those platforms as well. So when we see across all of that, why wouldn't you just use an AVM? Why wouldn't you just go for the cheapest option? Why wouldn't that be? What are the complexities with an AVM that's different to having a granular, localized valuer on the ground? So if we just go to the next slide here, I'm going to give a real example. Now, this is in Essendon. This is a property that sold in the last couple of weeks, right? So it was advertised last year and was taken off the market for a short period. It didn't get much over the high threes, and it's recently sold for 4.27. It actually made the age. So this is what's called the Mar Lodge estate. It's a premium estate where their single dwelling covenant applies, and everything in this area is prestige only. You can't build apartments, you can't build townhouses. People who are buying this are buying because they want to be accompanied by the same type of prestige home in that area. Now, this particular one, as you can see by the map there, in Jacker Street, it's north facing. It was on the high side of the street, and what that attracted was non-localized buyers. So there was a localized buyer at the start bidding, and then the two non-localized buyers started competing against another to purchase the property. That's an important key, because an AVM is not going to give you that information. It's just going to look at the transfer. It's going to look at the sale that happened. It's not going to look at why that buyer wanted this property over another. And that's a really important consideration. And when you go to the next slide, this is the Mar Lodge estate. So as you can see, that triangle or rectangle there, sorry, this is where all those buyers were bidding. Now, it's what's quite interesting is the Essendon Fields runway there actually runs below that, but people don't mind when they're in this prestige location. As soon as you fall out of it, it's a bit more of a consideration. But that single dwelling covenant is the key reason. So if you move to the next slide now and you look at this particular property, now this is directly opposite Jacker Street. It's on the Hedwick Street, which is the premium street of the Mar Lodge estate. Now, this particular property sold in the circa 2.8, something like that. Now, it's directly opposite a T intersection. So that means no non-localized buyer was actually interested in this property. And that's because of a feng shui element that doesn't meet their requirements. They don't like the T intersection. And this one here didn't go to auction like the other one did. It actually sold within its range, within its marketing period, because and the first buyer that went through was the one that ended up buying it. And he's a localized buyer that's going in to renovate it. So he was very familiar with the area. Their family goes to the local schools. So it's a different buyer buying both. Now, an AVM, if this was your property, as you can see, the key demand differences, if this was your property and you were doing an AVM, you wouldn't want the Jacker Street property considered. It's not the same buyer profile. It's not the same product, as you can see. All that is going to do is push your value up. So if your strategy was to go into a special purpose vehicle, or you were to transfer it into a super fund and you needed a conservative valuation for stamp duty transfer purposes, or you're not going to want a very high valuation, and this property is going to skew that by pushing it up because it got a premium price, and got a premium price for buyer demand that isn't relevant to your property. So that's why it is so key to have that localized knowledge. And when I was buying a property in Essendon and I wasn't from the area, I got 5 valuers to value my property independently. That was my AVM. That was how I did it. And I got them I asked them the same questions. What's it worth? Is this sale a consideration? Is this street a premium street? Would you buy this street over this street? And then they gave me all the same information independently. And that's what allowed me to make an informed decision. And that's that granular information that is so key. Now, moving along to the next slide, this is another factor that could influence your strategy in school zones. Like this is in Bentley now, Bentley East, McKinnon school zone. Being in and out of that McKinnon school zone is key. And depending on your strategy, you might want to be out of it or you might want to be in it. And that's why, getting that local knowledge, your client could be building a product that isn't for families. It's for corporates. Then they don't need to be in the McKinnon school zone, and you can buy a property at a cheaper rate for them. or you're not going to get the premium price because the home design doesn't meet the family requirement. So understanding your client strategy, we can inform you, we can give you pre-purchase advice, pre-sale advice, we could give you feasibility analysis advice, whether they're over capitalizing, what could be your gross realization value at the end if you're building apartments. We can give you all that information by understanding your client strategy and being on that journey. Right, moving along to the next slide. These are some other key attributes that an AVM would not recognize. So floor plan, is it meeting today's standards? After COVID, it was all about outdoor areas, study, working from home arrangements, natural light was a really big consideration, ancillary improvements. It had to tick all that. Car accommodation. People started buying premium luxury cars, and theft, especially places like Brighton, became a very big consideration. So really good car accommodation. Orientation is key. If you've got a pool in your backyard, you want to be north facing. You don't want to be east facing where most of the afternoon is going to be in the shadow. So the era Art Deco accommodation, fantastic. Still very demanded today and during COVID. And again, properties that might be, if you're doing an apartment complex or strategizing for your client, an apartment less than 50 square meters is a very difficult consideration when it comes to lending. And it also doesn't have the same equity growth as other traditional apartments above that size. So that's a really important thing. And we see that a lot with serviced apartments, And okay, moving along to this slide, fantastic. So the type of sale isn't considered in an AVM. So when you're looking at AVMs, they're looking at all transactions. They're looking at something that was just a will, something that a deceased estate transferred from one family member to another, just a transfer. Off the plan sales, the valuers can't consider, is a really big one. So when you do an off the plan sale, sometimes you're buying that property with stamp duty savings, with rebates, with rental guarantees. All those things don't meet the definition of market value. And when they resell a few years later, without that rebate, without that stamp duty savings, they generally get a very different price. And that's what we can give you advice on. So it's understanding those sales and what those sales require. Every single apartment complex in Melbourne is its own suburb, is its own tower. They've got their own cladding issues. They've got their own body corporate issues and benefits. Understanding that collectively, we can strategize with you for the growth of your property. And some of your clients won't want equity growth, but they just want to pay the property off quickly. They want a really good yield. They might want equity growth so they can pull money out and accumulate wealth. So depending on their strategies, we might be able to help find them properties or advise them that that's not the property that meets your strategy. So being put on that journey can really help advise your clients in a way that your competitors aren't doing. All right, moving along. So understanding the evidence. So this is a really key sale. Now, we went through this property at Optian twice. So I went through the one personally at 3.3. One of my colleagues went through it when it sold for 5.5. When it sold for 3.3, it hadn't hit COVID boom yet. And I was looking at that property, struggling to find the evidence to stack up 3.3. You paid a premium to secure it. It was on acreage property, not acreage, half acre, right on the cliff, looking at the water, beautiful block of land. Everything was good. Now, looking at that 2 years later, he was door knocked and it sold for 5.5. Now, if your property is nothing like that property, or what do you think that does to the AVM? That's going to push your property right up. Look at the land tax. Now, in this land tax example, I've just assumed the COVID deficit on both, but putting that in the state revenue website, assuming that that's the land value only, the person who bought it for 3.3 was going to knock down the home and do a big prestige rebuild, but it was a very habitable home. But assuming it was just a knockdown land, that's what the stamp duty difference is. And these are the sort of spin-off strategies that we can do, where we can provide a land tax objection to get your land tax down. We can provide advice on that premium, going, okay, that one sold for 5.5, but this is the reasons why your property is not that caliber. You're not going to achieve the same equity uplift to pull money out to buy something else. So, and in COVID, when that sold, the market is very different now. With the land tax obligations we have, residential tenancy obligations, the new vacant residential land tax, this type of property only really suits an owner-occupier market now, whereas historically people were renting these out as well. So this is where, we can come in and strategize and go, what are your plans? What is your strategy? What are you doing? And how can we advise you? But again, what would this have done to your AVM if your property wasn't like it? This is why getting that granular knowledge, understanding the fact that we went through the property twice and understood with the agent, we sat down with them and worked out who the buyers were, what was the underbidding offer, Was it off market? Was it on market? Was it freely advertised? We get all those fundamentals that you guys aren't exposed to, and we can form part of your solution. So moving along there, alternative products. Okay, so in the prior scenario, other products could have been used. Again, land tax. If you're looking to buy that property and everything else was selling for 5 mil, pre-purchase advice, making sure you're not making an overcommitment before you actually spend the money. Capital gains tax, if it was not your principal place of residence, how to minimize that gap. If the original sale was going to build like they were, tender review as if complete feasibility. Are you over-capitalizing for what you plan to do? And that might meet your strategy. You might be going, I'm holding it for 10 years, it's fine. But if you're looking to build and flip, that might not work for you. And we can give you that advice. We do so much construction valuations across Victoria. We're so astute with the rates. We've also got a quantity survey team that can give you that advice also, just to make sure you're not over-capitalizing, not spending too much, or even if the contract meets HIA standards, just to save yourself some risk. Moving along there. Okay, and based on all these alternative products that I've explained to you today, in a very quick summary, did you already have an existing need? Has this given you or sparked some ideas for you that you've got clients right now that you could deep dive with Optian and connect? And this is fantastic. So there's already over 77% of you that have a product that you need, or a client that you could benefit from all these alternative products that you didn't know before. And that excites me. We're going to have all of our details. I can be in residential, I can be your source of truth, your one point of contact across Australia. So you don't have to find out who do you have to speak to over there in a different state. You can deal with me exclusively across the country. And same with Ben on a commercial perspective. And our details will be up shortly for you to learn that. But there's so much of you already. There's 63% of you that don't have a need, and there's 37% that do have a need. So that's fantastic. That's actually really good, because that can grow. And once we sit down with your client and understand their needs, we can grow even further as a partnership. We also can start down the track to look at even growing that alternative product base and see where we can actually consistently use each other. At the moment, there's 63 that don't have an existing need. And that's okay. That's actually totally okay, because from this point forward, you'll be more astute to what we can provide. You'll be more clear with what Optian can provide, and we can grow from there. And now we're going to hand over to Ben. Thanks again for listening to me. And Ben, I'm really excited to see what you're going to have to pass on.
Yeah, thanks, Salsi. Always hard to follow. Salsi is very passionate about his valuation, so thanks for that. And just quickly before I start, just wanted to thank again our partners at VGL for allowing this forum, and obviously for all the attendees on the call. So my role is to lead a team of professionals who value commercial property throughout Southeast Queensland. I'm based in Brisbane. We cover sort of the whole Southeast Queensland regional market. Predominantly we're valuing assets, or core commercial assets, we'll call them. That's your retail shops, commercial offices, and industrial workshops and warehouses. Generally under 10 million, but we also have specialists in our team that do childcare centres, service stations, and some larger investment assets as well. Again, reiterating what Salsi was saying, we've actually got one of the biggest national coverages in the industry. We've probably got 60 to 70 commercial valuers across Australia in all major cities and most regional centres as well, along with some smaller towns. Now, before I jump into a local market snapshot, I just wanted to ask the contingent on the call, do you or your clients have commercial properties in your SMSF? We're just trying to get a bit of a gauge on what the size of this market is. If you do you get real estate advice updates to inform the trustees or AVMs, or do you use valuations regularly, or no, you don't have any, or don't care, or don't know? This information just helps us with our marketing strategies and to see what sort of market we're captured. All right, great. So it looks like most the the majority of people that do have commercial properties are using valuations, which is really good to hear. We'll probably reaffirm some of the positive reasons for that. But also for those, there's about 30% that are using real estate advice or AVMs. We know that's historically where the market has been for commercial properties. You know, trustees using their local agent used to write them a letter, say, yep, Bill, it's worth $1 million this year. It's worth $1 million last year. What sort of rent do you want us to tell you it is? That's what it is. But with the increased scrutiny, auditors sort of, some changes in legislation too, I should say, there needs to be some evidence around the parameters set now. And we've been finding agents are a little bit less willing than they used to be to help out the SMSF industry. Anyway, I'll touch on the local market now. So just before I start, another disclaimer. It's what I say here is very general, but it's also mainly relevant to our local market. To find out what's happening in your or your clients' local markets, I suggest you reach out to your local Optian valuer in that market. So anyone who's had anything to do with the commercial property sector since COVID is probably well aware of the industrial sector. It's really been the workhorse over the past 5 years. It's probably the best performing asset class, having doubled in value, roughly, say 70% to 100% growth since pre-COVID. And sorry, I'm just mixed up on my own slide here. Yeah, a lot of that's underpinned by the rental growth. So there's a big shortage of supply. COVID hit, we had homegrown manufacturing increase and a lot more warehousing requirements. So incredible demand for industrial space, which spurred the rental growth. Also underpinning that is, you know, significant increases in construction costs, costs to develop. Land costs have also gone up, and those costs to develop have required a rental return, which has also spurred that rental growth. Now, so there's been huge growth over the past 5 years, but we're probably hearing from agents now that that rental growth has stabilised. There's affordability pressures coming onto industrial users now, and there's been also a bit of yield expansion, so softening of yields, which is probably steadying up the values compared to the growth that we've seen in the last few years. Moving on to the office market, again, it's probably had almost a similar amount of press coverage over the last few years. We're all aware of the big work from home movement. There's, I guess, different demand drivers across different states at the moment in the office market. Brisbane and Southeast Queensland is actually one of the leading markets across the nation for the office sector. We've had probably a better return to the office environment take up. We've also got this emerging supply side shortage. So we've got probably some of the best occupancy rates of offices across the country. That's spurred rental growth, which has been quite strong and probably a little bit underreported in that same media. It's probably in the order of 10 to 20% over the past 18 months, predominantly for prime grade assets, which is starting to pique the interest of some investors. Yields have softened also over the last couple of years, particularly since interest rates increased. But we're starting to see a little bit of speculative investment activity, while we haven't seen any strong sales as yet. And I don't like to predict the future. I'm going to say it's probably the sector with the most opportunity at the moment. If we go on to the next slide, the retail market, again, just going to disclaim it's such a broad segment. So the retail sector, we include service stations, we include medical centres, we include large format, you know, your Bunnings or even just your JB Hi-Fis and Officeworks, right down to your small neighbourhood or strip shops, even say your local coffee shop or a strata. a strata shop somewhere. It's such a broad range, and all of those little sub-markets sort of act at different on different metrics, experience different demand at different times. But overwhelmingly, we've probably noted in the areas that we play in, it's performed better than expected at this point. You know, we're all aware of the cost of living crisis. Expenses have gone up. We're expecting shoppers to shop less, yet we're finding there's been adequate demand, tenant demand that is, for new premises, particularly in those smaller segments. You know, if someone's paying under sort of 50 grand a year in rent to open up their, you know, new coffee shop or whatever it is, there's still adequate demand in that space, and the rental growth's actually been better than expected as well, at least keeping up with CPI, and we all know CPI has been quite strong lately. So again, performing better than we thought. From a yield perspective, it has softened again since the peak of the market, yet they're still in pretty strong demand, generally in that 6 to 7% range. So a pretty good return compared to most of the rest of the major capitals on the eastern seaboard. And overall, probably steady to maybe slight increase in value levels. Aside from that local market update, and probably heading into a more evaluation technical standpoint, the key differences between residential and commercial valuations is that, or property in general, is that the commercial properties are generally underpinned by their net income. So there's a really strong correlation between what the net income you can get from that asset is to what the property is worth. So while it's easy enough to say, you know, a shed is going to be $3,000 a square metre, it actually fluctuates a lot further than that in a day-to-day or an individual transaction. So what the valuers have to do then is look right into what is the current rent, you know, if it's leased, how does that compare to what it could be getting, you know, is it under rented, is there potential for growth? Then we have a look at the outgoings, you know, is that there's been huge underlying land growth, which has prompted a lot of land tax increases. Now, sometimes that's recoverable from the tenant, and that's an occupancy cost for them. Sometimes it's not, and that's a burden to the landlord. So there's a lot of different factors, but I guess if you partner with a firm like Optian that has quite a big national spread and is very active, probably if not the most active in these market segments, is that we've really got an excellent database for rents, which is not a publicly available information. So we get that through the work that we do day to day on specific properties, but also through actively managing relationships with leasing agents in different subsectors. So I guess when you partner with Optian, you leverage those relationships as well. So that's probably the main difference between residential and commercial, is just that we spend a lot more time on the income side of things and the market rent. Now, I'll just touch on a couple of case studies I've done for SMSF. These were, I guess, maybe not your most typical SMSF assignments, but this first one was a strata office suite in the Brisbane CBD. A trustee, hopefully not on the call, I can only assume had maybe let slip his governance, and his accountant came to us and said, look, we need retrospective valuations for the last 3 years because we haven't got any reliable information. We need market rents and we need market valuations. So I said, look, that is absolutely fine. Leveraging our database that we already had in place, we had information for all those past years ready to go. We also had been operating in that market during those periods, so we knew what was happening back then. Already had the evidence ready to go. This particular property was a little bit curly. In 2022, it was flood damaged, which caused probably not too bad a demand and impact for the building itself from a rental perspective ongoing, but it did impact the landlords because they had additional body corporate levies or special levies to pay for flood mitigation works and repair works. So again, as a quick, for what could be quite a complex valuation, it was quite a speedy service delivery for that client. For my second case study, again, not your typical SMSF holding. This is a larger industrial property. It's about $15 million. It came about through one of the partners owned the property in his super fund. He used to be a business partner in the tenant within the building. He'd got out several years ago, had sort of, I guess, been excluded from the business dealings and felt like he hadn't caught up with the rental growth and was being kept in the dark a little bit. So we were doing their annual audit, but also informing them on the market rent, what they should be achieving, and then he was able to negotiate new lease terms on that information, which was greatly beneficial. And then it also, a subsequent follow-up to that was informing him on a disposal strategy. So he was looking to potentially get out of that. And we discussed, it was probably more favourable to have a shorter lease term because we've got stronger market fundamentals from owner-occupiers than leased assets. So again, it was the value add from partnering with a local property expert that worked well for the client, for the trustee. Now, all that aside, again, jumping around a little bit, knowing everyone on the call, I'm sure you're all across the Div 296 proposed changes, but for anyone that's not, the Division 296 proposed changes is basically looking to increase the tax rate another 15% for anyone with self-managed super fund balances above 3 million. So any growth in that, including unrealised capital gains, is looking to be subject to annual tax, set to take effect from the 1st of July 2025. Hopefully it will be delayed. But I just wanted to get the feel for the room on what they think of the Div 296. It's a good thing. It'll be more equitable for the nation, or it's going to create additional work for you and I, and more fees, or is it just a bit of a tax grab by the government of the day? So I'm not sure whether you guys can see the live polling on this, but yeah, most agree. Nearly 2/3. It's just a bit of a tax grab. Seems crazy. It's obviously going to hurt your clientele. A third of it don't really have an opinion on it, and a few people are excited about it, which is interesting. So I guess my own view, and it is a personal view. It's probably, I'm not in huge favour of it. I think there's probably other ways to achieve what they're trying to achieve. But I guess what we're seeing here is increased scrutiny on the self-managed super fund space. There's going to be continued scrutiny and increased governance requirements. So I think now is, if you haven't already, is a good time to start looking at partnering with a valuation firm that has that local knowledge. So yeah, and we're obviously happy to be that valuer.